If you're living in this present age, you cannot deny that there's so much emphasis on investment. Everywhere you look, you're hearing stories about someone who made a terrible investment decision or someone who's lost all their fortunes to shady deals. Either way, it's been thrown at your face daily. Let's face it, sometimes it can be annoying, especially when you don't see the need for these investments. But as much as we might not admit it, we do need to know all the financial lingo and understand completely what each investment means to us and what it offers our future. This is why in this video, we're going to be talking about the VFV ETF and why you should or shouldn't invest in it. Hey there, welcome to my channel. If this is your first time, I'm glad you made it to this video. Please subscribe to my channel and click on the notification bell so that you get updates whenever I upload new content. If you've been here before, thank you so much for finding your way back, and don't forget to like this video. Before we go into the VFV ETF, let's talk about what the ETF in general is. What are ETFs? ETFs, also known as exchange traded funds, are investment funds that are traded on stock exchanges. They are put up for sale publicly and contain assets such as stocks, shares, bonds, and so on. Most ETFs are index funds, which is a type of fund where the goal is to imitate the market rather than trying to beat it. The most popular ETF is at this recording is the S&P 500. ETFs can either choose to be transparent or non-transparent. This means that they could choose to expose their daily dealings or their properties online or not. Transparent ETFs, however, choose to show the list of stocks they own as well as their weighting on their websites every day. ETFs generally have an annual fee or an expense ratio of about 0.03% to 1%, depending on the one which you choose to patronize and how much you choose to invest. ETFs divide ownership between shareholders, making it possible for them to participate in owning percentages of the company's shares. This means that they indirectly own the assets of the fund and get annual reports. They also earn interest and dividends from the business. ETFs are a good form of investment because it offers their customers low-cost services, taxation, market diversification, and transparency. Its low-cost service is what makes it possible for people who are not millionaires to be able to invest. It is pocket-friendly and inclusive when it comes to pricing. And even though you invest so little, if you're patient enough, you get to receive so much dividend in return. Market diversification, as I've mentioned earlier, is another reason why people invest in ETFs. ETFs are not dependent on one particular sector of the economy or on one company to thrive. They invest in several companies and several sectors, and in the end, if something happens to one of these institutions, they will not be so greatly affected. In simple English, or in simple terms, they don't put all their eggs in one basket. Lastly, the ETFs offer some level of transparency, and this helps to put the minds of investors at rest in terms of their money. Now, let's talk about VFV ETFs. Simply known as the Vanguard S&P 500 ETF, is an investment whose goals are to track the performance of the S&P 500. It is a largely diversified index, predominantly made up of value stocks of large US companies. VFV uses the indexing investment approach as a means to achieve this. In this system, the advisor attempts to replicate the target index, in this case the S&P 500, by investing all or some of its assets into the stocks that make up the index and holding each stock in approximately equal standards to the ones in the index. Now, the pros of choosing the VFV outweigh the cons, and some of them include: 1. Its low cost, effective tracking, and simplicity. Compared to the other funds, especially the mutual ones, the VFV ETF doesn't take as much from investors in the name of management fees. It has an MER or management expense ratio at a rate of about 0.09% per annum. They also pay their investors dividends quarterly. Secondly, the VFV ETF has very close tracking to the S&P 500. This means that they've managed to study the methods that this index thrives on and can replicate it excellently to around 99%. So, They enjoy as much success as the S&P 500 does and provide their customers with the best. This ETF has managed to keep things simple for its audience, taking them every step of the way so they know where their money is going and how it is growing. They are transparent, simple, and this makes them a more effective choice. One downside to this whole system is that they're more dependent on the tech sector than any other sector available. This means that they will suffer great losses if there is to be a crisis in the tech industry. As much as they're diversified to a point, many percentages of their investment go to tech companies all around the US. Now, I hope this has helped you understand the Vanguard S&P 500, also known as the VFV, and now it's left for you to decide where you want to put your money or where you want your money to go. If you've enjoyed this video, please subscribe to the channel and leave a comment below. And if you're already into financial investments, you can drop a comment to let me know what ETFs are worth looking at and how it's been going so far. Don't forget to share this video with your friends. I'm Peter, and I'll see you in my next video. Bye.